Okay, welcome to another video, and today we're going to be looking at global growth in question. It's a bit of an ominous headline. Now, first thing before we get into it, you probably noticed that that the report is looking a little bit different this time, and that's because we've moved into a new format for the PDF version. And so we're actually making this here edition 20, the 20th one for the year. Look at the year go by. So that one's going to be available on the website for download for free. I will put the link in the information section for the video as well. But basically we've got the title page here, and it's got the key points. So you can kind of figure out what parts or whether you want to read it from the front page, and then you go into the first one, for example, which is one that we're going to be talking about. Global growth in question has the key points there, the bottom line, which is really just a bite-sized summary of the view, and then we go into the charts, and that's probably our cue to get into the charts. So first one is really, this one is the one that's calling it all into question. So we've got the Composite PMI there, which is a composite of America, Europe and Japan. So it's the major developed economies. It's those ones because they've got a flash result, so you can get a bit of a sneak preview later in the month before the final result comes out. That's compared to the 10-year bond yields, and you can see that they're both going in the same direction. You could have argued perhaps that the bond yields should be a little bit higher based on where the PMI is tracking. And certainly, earlier in the year, it was making a case for a US 10-year yield at 3%. And so, really, this here, the fact that bond yields have really rolled over, so that PMI. And if you look more broadly across the PMIs, we're seeing a bit more divergence now versus this really synchronized surge here. So is it time to get all beat up on the global economy? Is this going to go roll over and then down? Or is it a case of consolidation or maybe even better growth? And so the next four charts are really going to be illustrating why I think that actually things aren't that bad. I've put the bullet points here, but we'll go for the charts first. So first one, and really one that I think is one that everyone who's interested in the global economy should be having on their radar, is this here chart. So this is property prices in the major economies, and this is the ones that really make up the major chunks there. So the US, the Eurozone and China. And what we're seeing here is all three of those are seeing positive year-on-year property price growth rates. Last time that we saw that was back here, and that's prior to the crisis. And so that's quite a different, very different environment there. And it's something that we haven't seen. Everyone is sort of doing their own thing throughout this period here, and but now that everyone's seeing positive price gains, the first thing really that does is it makes the consumer over here feel pretty good, because they're seeing the value of their house go up, and also you think about property prices going up. What does that do? That property is pretty much the key asset for banks, so it makes life easier for banks to lend, and makes life easier for banks more broadly, so they can pump out those consumer loans. The other thing it does is there's a whole lot of industries that are associated with the property markets, and certainly for the larger developed economies, because the consumer is so sensitive to that, the property sector is really actually quite key. And then of course in China, where it's a developing economy, property is actually still very key, and probably one of the most important indicators for China. There is a concern that's rolling over, so that's something to keep an eye on. Once that rolls over, global growth doesn't become in question. Global growth gets bearish. So at the moment, while they're all still positive, and while consumer sentiment's ticking up, that's those are a couple of key supports there. And I think the fact that we're seeing both emerging markets, which is the dark line, and developed economies, which is the blue line, turning up there on the consumer sentiment front, that's quite a strong support really. And then going into the next one, so what we've got here is global trade growth. And the blue line is shipping container throughput, black line is global import volume growth, and the red line is a leading indicator of the former two ones. And You can see there that whether it's the hard data, the volumes, or the softer data, the PMI index that makes up the leading indicator, global trade growth has rebounded and accelerated to a pretty decent pace there. I think it's probably going to cap out at that level, which is a decent level by post-crisis standards. And that's a very important part for global growth, particularly for those more export-sensitive countries. And it also helps broaden out the growth as well, because the moment you start seeing one economy's strong growth sort of flow through to export demand, it helps some of the other ones. And this one here is called the deflator meter, and really what I'm just trying to illustrate with this one is the fact that industrial production and corporate earnings are looking better. So what this chart is the count or proportion of countries with negative growth rates or deflating sort of situations. So really quite a remarkable observation here is that throughout the post-crisis period, about 40 to 50% of countries, almost half countries that are monitored on this, are actually seen declining rates of industrial production growth, which is really quite remarkable. And stands in contrast to the pre-crisis zone there, which was around that 10 to 20% range. And on the earnings front, there was basically no countries with declining forward earnings, earnings downgrades on a year-on-year basis. And so what that is there is really big turnaround in earnings, and also you see that there point big sort of clean out moment there, I guess, in a way. That's when about 70% of countries there were seeing declining forward earnings, which is a big thing. So really, you've got global trade growth looking better. Industrial production growth has rebounded in many places. Same thing with corporate earnings. Property prices are improving in the major economies, and you've got pretty strong consumer sentiment. And so when we come back to this one, does that mean that we're in one of these kind of situations here? I don't think so, based on what we've seen back there. And the other thing that I mentioned here too was monetary policy remains supportive, even if the Fed goes and hikes another 2 times. There's still very substantial stimulus out there. That is, the tightening stimulus, the point where monetary policy becomes a headwind. That's probably a story for next year. In the meantime, we've probably got a window where global growth can do actually reasonably well, and so I wouldn't be sitting here expecting bond yields to be going down for anything other than just a technical sort of market correction kind of thing. And you might argue that they've already been through that. And so I guess at that point I'll leave it there. There's a lot to discuss, a lot to think about on this. Again, if those supports turn, if any one of them or all of them drop away, then that's definitely a reason to get bearish. We're monitoring those very closely, so you'll hear from us before you hear from anyone else. I think if you start to see those indicators roll over, especially the leading ones, and I'm constantly sitting here trying to come up with new leading indicators that will provide that extra insight. Innovation, I think, is really very critical when it comes to investing such a competitive endeavor. So, that's just a good reason to stick with us. Check out the report. Definitely go and download this one, because this one is the one and only one being made available for free. And if you like it, then go ahead and take out a free trial. And if you want to go straight ahead with the subscription, then get in touch and we'll set that up. So that's it, and be sure to subscribe to the channel.